This is Nightly Business Report with Sue Herrera and Bill Griffin.
Focus on fundamentals. The Dow rises ahead of the midterm elections, but it wasn't politics that investors paid attention to.
Red hot. Businesses can't find enough workers to fill jobs. Will the labor market cool on its own, or will the Fed end the party?
Split decision. Why Amazon's new second headquarters could end up being a tale of two cities. Those stories and more tonight on Nightly Business Report for this Monday, November the 5th.
And good evening, everyone, and welcome. Both the Bulls and the Bears were out in force on the eve of the midterm elections. But it wasn't because Americans head to the polls tomorrow, but rather it was because investors were focused on a number of fundamental issues within the market. The Bulls led the broader market higher, while the Bears trapped the tech sector and pushed that group lower. So here are the closing numbers. The Dow Jones Industrial Average rose 190 points to 25,461. The Nasdaq fell 28, and the S&P 500 was up 15. Bob Pisani takes a closer look at today's mixed market.
Stocks largely rallied ahead of Election Day tomorrow, with the Dow soaring triple digits, though ending off the day's highs. Reports are all abuzz about what the midterms could mean for stocks, but the market moves today weren't tied to any specific election concerns. Fundamentals still very much front and center. The bigger story by far is the Federal Reserve, slated to meet later this week, and what officials decide to do about interest rates. In the best case scenario, the Fed will keep looking at the data and remain sensitive to the pace of economic growth, both in the jobs market and beyond. In other words, not hiking too aggressively. Oil was perhaps a big driver of today's market rally. Energy stocks like Chevron and ExxonMobil jumped after the U.S. reimposed sanctions on Iranian oil production, and natural gas also jumped. Elsewhere, the Dow powered ahead despite a slump in Apple shares. Apple drew a second downgrade from Wall Street analysts in the wake of its quarterly earnings report on Thursday, and amid reports of a possible slowdown in demand for its iPhone XR model. President Donald Trump also said he was considering looking into antitrust violations against major tech firms like Facebook, Amazon, and Google parent Alphabet. That put pressure on the Nasdaq, which fell back into correction territory, down 10% from recent highs. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So what do the midterms mean for the market? Well, Dominic Chu breaks down the different possible scenarios.
The most expensive midterm election in American history takes place tomorrow. The general consensus among Washington watchers and Wall Street strategists is that the Democrats take control of the House while the Senate remains controlled by the Republicans. A divided Congress. A less likely scenario is that Republicans retain control of both houses of Congress, which is the current situation, and a very unlikely scenario would see the Democrats somehow win control of both the House and the Senate. Under the likely scenario of a split Congress, history points to market gains ahead, even if there's shorter-term volatility around the election itself. And that's because a gridlock Congress may be unlikely to push through any kind of major legislation, which could allow businesses the freedom to operate without fear of major regulatory change. Sectors like healthcare and defense could see potential upside with no real ability to change the current state of drug prices or defense spending. If Republicans somehow keep both chambers, it could be very short-term bullish for stocks, given the prospects for more tax cuts, government spending, and less potential regulation. Perhaps a good environment for retailers and energy companies. Tough questions, though, will remain over the budget deficit, and they will be more pronounced. If, by some chance, Democrats manage to win both houses, there's the possibility for more regulation that could hurt, say, the banks and the drug companies. But at this point, all of those projections are just speculation. While tomorrow's big elections will have an impact on how certain investors react, many experts still maintain that this is a shorter-term issue that shouldn't affect one's long-term investing plans, and that issues like global trade are far more important to the health of the overall market and global economy. For Nightly Business Report, I'm Dominic Chu.
And according to MarketWatch, since 1946, there have been 18 midterm elections, and after every single one, stocks were trading higher 12 months later. Did the election results matter? You decide. During those 72 years, we have seen every possible political combination of parties controlling the White House and both chambers of Congress.
As Bob Pisani mentioned, tech stocks did come under pressure today, and comments from the president were in focus. In a video interview with Axios reporters, President Trump said his administration is considering antitrust action against some of the major tech companies.
But what about monopoly? What about saying the Justice Department look into the
I
monopoly?
have so many people saying that, but it's certainly something that we have looked at.
Would you ever break them up?
They were talking about this years ago. You know, they were actually talking about this same subject, monopoly, years ago, long before I was in office.
Do you think you'll be the man to do it?
In fact, a lot of people thought it was going to happen, and then I guess a previous administration stopped it from happening.
But you're in charge now.
I'm in charge. I am definitely in charge, and we are certainly looking at it.
This is antitrust.
Antitrust, yes.
Right. For Amazon.
For all three.
We have been reporting that increased regulation is a risk for the tech sector, and today Amazon, Google's parent company Alphabet, and Facebook all traded lower.
Now to trade rumblings, which of course have been an ongoing concern for the markets. President Trump said today that China is interested in reaching some sort of an agreement, but that he will only move forward if it's a fair deal. The leaders of the two world's largest economies are expected to meet at that G20 summit in Argentina at the end of this month.
Meantime, China's president wants to convince the world that his country is shifting from being a global exporter to an importing powerhouse. Eunice Yoon reports tonight from a trade expo in Shanghai.
President Xi Jinping wants to convince the rest of the world that China wants to buy more of their stuff. At this expo here in Shanghai, one of President Xi's pet projects, he said that China would make the necessary changes so that Chinese consumers could become even more important to the global economy. That means promises for further tariff cuts, greater market access, a tougher stance on IPR violators, and creating what he described as a first-class environment for foreign businesses. The problem is that he didn't get specific on even one issue, nor did he address the U.S. trade war directly. That had left many diplomats and executives here with a sense of deja vu. There's widespread frustration that the Chinese government, despite its promises, is not opening up in the way that businesses feel is fair. The Trump administration did not send a delegation here, and there are only a few global CEOs. At the same time, some Chinese business leaders are getting frustrated by the rhetoric out of the White House. Alibaba's Jack Ma is here in Shanghai, and he described the trade war as the most stupid thing on the planet. Some believe that President Xi could be saving his offers for the next possible meeting with President Trump at the G20 summit later this month. But so far, there's no sign that China is going to cave in to the U.S. If anything, President Xi doubled down today. He described China as an ocean that has survived 5,000 years of storms, and he pointed out that China is still around. For Nightly Business Report, I'm Eunice Yoon in Shanghai.
Meanwhile, a new analysis of government data put together by a coalition of business groups shows how tariffs are affecting American industry so far and where they're being felt. Ilan Mui has the details for us.
President Trump's trade wars are costing businesses big money. The White House has slapped tariffs on foreign steel and aluminum. Chinese imports are getting hit too. It's all part of Trump's push to rewrite bad trade deals, but it's also raising costs for American companies. $1.4 billion. That's the new estimate of how much businesses paid in Trump tariffs in September alone.
We need to show American leadership. We need to build the right kind of coalition, and tariffs are the wrong way to do this. They just simply impose cost on American business, farmers, and consumers. They're a tax, a massive tax.
That could sway some of the tightest midterm elections tomorrow. Red states, where Republicans are hoping to eke out a win, are feeling plenty of pain. Take Indiana. The tariffs cost businesses there an extra $30 million in September, nearly 4 times what they paid last year. In Missouri, it was $14 million. West Virginia paid an extra $2 million. On top of that, some states are getting hit by retaliatory tariffs as countries strike back against the U.S. North Dakota, an important agricultural state, it normally sells lots of soybeans to China. Exports there have plunged an estimated 94%. The Trump administration says the short-term pain will be worth the long-term gain of better trade deals and an end to Chinese malpractice.
We can use the tariffs as leverage, and right now they're certainly not hurting the economy. I mean, our economy is doing really, really well. So now's the time to use that leverage, and that's what we're encouraging the Trump administration to do right now.
There is hope that tensions with our trading partners will ease over the next few months, but until then, the cost of tariffs keeps adding up. For Nightly Business Report, I'm Ilan Mui in Washington.
U.S. sanctions on Iranian oil kicked in today. The sanctions are part of the White House's effort to curb Iran's missile and nuclear programs and to weaken its influence in the Middle East.
The Iranian regime has a choice. It can either do a 180-degree turn from its outlaw course of action and act like a normal country, or it can see its economy crumble. We hope a new agreement with Iran is possible. But until Iran makes changes in the 12 ways that I listed in May, we will be relentless in exerting pressure on the regime.
Iran, however, remains defiant, saying it will break with the sanctions and continue to sell oil abroad. The U.S. did grant 8 countries temporary waivers, allowing them to keep buying oil from Iran. And the president today said he wants to impose the sanctions gradually. After rising earlier in the day and then falling back a bit, the price of domestic crude dipped 4 cents, extending a 5-day slump.
Time to take a look at some of today's upgrades and downgrades. We begin tonight with a downgrade that Bob mentioned earlier. That's Apple's rating cut to neutral from buy at Rosenblatt Securities. This is the second downgrade for that stock since its earnings report of last week. The analyst cited lower expectations for iPhone production and shipments. Price target now $200, and that stock fell more than 2.5% today to $201.59. Netflix's rating was raised to buy from underperform at Buckingham. The analyst cited the 27% decline in that stock price since mid-July. Price target $406. The stock rose 2% today to $315.44.
Chevron was upgraded to outperform from neutral at Credit Suisse. The analyst cites Chevron's operational execution and potential for free cash flow. The price target is $138. The stock gained more than 3.5% to $118.94. Starbucks was upgraded to buy from neutral at Mizuho Securities. The analyst says the company's earnings growth is set to accelerate. The price target is $75. The stock rose just a fraction to $64.48.
Still ahead, an industry divided. The San Francisco ballot initiative that is pitting companies in technology against each other.
The services sector expanded more than expected in October as economic growth remains strong. According to the ISM non-manufacturing survey, almost every major service industry expanded last month. The only one to show a decline was education. The biggest complaints among companies were around the uncertainty created by the tariffs and the lack of workers to fill jobs.
Speaking of which, the restaurant industry in particular is feeling the effects of our tight labor market. Kate Rogers rounds up some recent comments by CEOs.
Restaurant companies are feeling the squeeze of a tight labor market. On earnings calls this season, companies across the sector said they're hiking wages to attract workers, but some are still facing a shortage in an industry where employee retention is notoriously difficult. At Dunkin' Donuts, CEO David Hoffman said staffing is the franchisee's #1 challenge, adding it's a reflection of a strong economy. To offset those challenges, Dunkin' is focusing on building and maintaining a culture that draws workers in and offers flexibility. Domino's CEO Richard Allison said the brand isn't immune to the tight labor market, but said franchisees are hiring drivers. The strong economy also means more people are ordering pizzas, which is good for business.
Have a good day. Thank you.
The delivery drivers already working are extremely busy, giving them an opportunity to make more money. Meanwhile, Shake Shack CEO Randy Garutti noted mid-single-digit increases in wages, projecting the same hikes next year. Garutti said in a competitive environment, on-demand jobs in the gig economy have begun to compete compete with traditional restaurant jobs, which can be a challenge when it comes to hiring. One notable exception, Starbucks. The coffee giant isn't currently struggling to find workers, Chief Operating Officer Rosalind Brewer told CNBC. Starbucks is known for its company culture and employee benefits. For Nightly Business Report, I'm Kate Rogers.
But it's not just the restaurant business that is feeling the effects of a tight labor market. The need for workers is rippling through the broader economy. Steve Leisman has the details.
Remember the old song, feeling hot, hot, hot? Well, that by any measure is the best way to describe today's job market. And while economists, well, they don't often break out in a song, the 250,000 jobs created in October and the low 3.7% unemployment rate, that's evokes some exuberant language. Goldman Sachs writes in a research report, quote, labor market tightness is moving to levels rarely seen in post-war history at the national level. It expects unemployment to fall to 3%.
We saw an unemployment rate recently that was the lowest since 1969. So that marks it as pretty hot. And of course, 1969 was an outlier. And the next thing that did happen is unemployment went right back up. I don't know if we can stay at this level of heat for very long.
Well, just how hot is the job market? A broad measure of labor slack, that is, extra workers out there. It counts the unemployed, those marginally attached to the labor force, and those working part-time because they can't find full-time work. At 12.1 million, or 7.4%, it's around the lowest since 2006. Remember, the Fed funds rate around there was 5.25% compared to around 2.25% now. Bottom line, there aren't a lot of bodies out there to fill vacant jobs, all of which raises the question about whether the job market will cool of its own accord or if the Fed is going to have to end the party. Goldman Sachs wrote, quote, the economy really needs to slow to avoid dangerous overheating.
I wouldn't call it a strong economy. I would call it an exuberant economy. So we have to maybe end the party a little bit.
The Fed would like to avoid slamming on the brakes on the economy too hard. But if inflation breaks out because of the hot, hot, hot jobs market, well, they may find themselves having to hike. For Nightly Business Report, I'm Steve Leisman.
CEOs are buying stock, and that's where we begin tonight's market focus. General Electric's recently appointed chairman and CEO Larry Culp bought more than $2 million worth of his own company shares last week. It happened the day before they closed at their lowest price in nearly a decade. And separately, a regulatory filing shows that IBM CEO Ginni Rometty bought $3 million worth of her company's shares. Comes a week after IBM announced its purchase of Red Hat for $34 billion. Shares of those companies, IBM rose nearly 4% today to $120.06. Shares of GE were down a tick to $9.28. Food services business Cisco reported weaker than expected profit and sales in its most recent quarter. The company said that its costs are outpacing the price increases that it was able to pass to customers. A tight labor market and a rise in overtime pay are contributing to those higher costs. Cisco shares finished down 9% today to $64.56. And results of a new clinical trial show that Eli Lilly's top-selling diabetes drug reduced the risk of heart attack and stroke in people with type 2 diabetes. The company did not detail the magnitude of the risk reduction, but executives did say that they plan to release the full results of that large-scale clinical trial in June. Eli Lilly shares rose 3% to $110.14 today.
Verizon is restructuring its business lines based on the types of customers served rather than by the type of service provided. The three groups will be Consumer, Business, and Verizon Media Group, Oath. This is one of the first major organizational changes under Verizon's new CEO. Verizon shares finished up 1% to $57.21. Berkshire Hathaway's profit nearly doubled in the most recent quarter. The conglomerate reported earnings over the weekend and said its insurance business benefited from lower taxes. Chairman and CEO Warren Buffett repurchased about $900 million in stock in the third quarter. Shares of Berkshire Hathaway Class A popped 5% to more than $323,000. And after the bell, Marriott International reported better than expected profits, but its total sales came up short. And that sent the stock initially lower in after hours. It also finished the regular day down a fraction to $120.68.
Voters in San Francisco tomorrow will be going to the polls voting on a ballot measure that has divided the tech industry and spurred debate over the issue of corporate responsibility. Aditi Roy has more.
It's one of the most serious issues confronting San Francisco, the growing number of people living on the streets. San Francisco currently has 7,500 homeless people, 1,000 more than it had just 5 years ago. Now, Proposition C aims to solve the problem by taxing businesses in San Francisco up to 1.5%, depending on how much money the company makes. By doing so, the measure would double the city's homeless budget.
We have a humanitarian crisis of epic proportions.
Mark Benioff is the CEO of Salesforce, the city's largest private employer. He's one of the most vocal proponents of Prop C, despite the fact that if the measure passes, Salesforce would have to pay about $11 million in taxes the first year.
These numbers are really immaterial against the cost of homelessness today. That is, for our employees who don't feel safe on the streets, or they don't feel safe in the BART stations, they don't feel safe walking to work, that's a much greater cost than the financial numbers. And any CEO who says that this financial number is too big or unfair or unbalanced isn't looking into the homeless themselves and understanding we have a very serious situation. This is a crisis.
Together, Salesforce and Benioff have contributed nearly $8 million supporting the campaign. But a number of companies have bankrolled the opposition, including Stripe, Visa, Lyft, Charles Schwab, and Marriott International. The San Francisco Chamber of Commerce says the tax would prevent companies from moving to the city. One of the most outspoken critics of the measure is Square and Twitter CEO Jack Dorsey. He got into a Twitter debate on the issue with Benioff. Dorsey says Square would have to pay an extra $20 million from the tax the first year, since the measure classifies financial companies differently from software companies. But Benioff counters that's a small price to pay to solve what he calls a crisis of inaction.
Well, I so strongly believe that business is the greatest platform for change, and that businesses cannot be extracted from the cities that they do business in.
As far as how Benioff explains his support of the measure to investors, he says the proposal does make business sense because the rise of homelessness impacts the company's ability to recruit talent, which is a challenge for businesses here. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Coming up, the plot thickens. Why Amazon may be ready to crown not one, but two winners for its second headquarters location. Gas prices have been falling for the fourth straight week. In fact, the national average price for a gallon of gasoline is $2.76, the lowest level since April. And while it's cheaper than 6 months ago, today's national average is 24 cents higher from a year ago. AAA says, though, prices could go even lower if demand continues to weaken. But get ready to pay more for your packages that are shipped by FedEx. The delivery giant said today that customers will be facing higher shipping rates starting in January because transportation costs are pressuring their results. Rates for FedEx Express and FedEx Ground will rise by nearly 5%. FedEx freight prices will climb by nearly 6%. Shares of FedEx finished up a fraction today to $222.61. Amazon, meanwhile, is offering free shipping with no minimums during the holiday season. It is the first time the e-commerce giant has offered the service for non-Prime members. Amazon said the deal, however, expires once the company can no longer promise deliveries in time for Christmas with the free shipping option. Speaking of Amazon, it turns out the company may not be eyeing one location for its second headquarters, but two. NBC News and the Wall Street Journal are reporting that after more than a year of deliberations, the e-commerce giant has decided to split its so-called HQ2 between two cities, with 25,000 employees to be hired in each location. Amazon is said to be in final discussions with officials in New York, Dallas, and Northern Virginia, and that's where we find our Scott Cohn tonight.
The Arlington, Virginia neighborhood known as Crystal City holds some clear advantages for Amazon. Reagan National Airport is minutes away. So is the nation's capital, a short ride on the metro. The Pentagon is right next door, a big Amazon customer. And there's already lots of vacant office space from defense contractors that used to be here. But perhaps most important, this area has workers, well-educated workers, and Amazon has plans to hire 50,000 of them.
I think it would be pretty awesome. I think it would potentially end up creating a better workforce around here.
A source with knowledge of the process says Amazon held a lengthy conference call with local officials here last week. Among the topics, a big transportation upgrade. But the ultimate decision almost certainly rests with CEO Jeff Bezos, who said just last week, you collect as much data as you can, you immerse yourself in that data, but then you make the decision with your heart. Bezos already owns the Washington Post, and he's renovating a home here. No wonder 3 D.C. area locations made the finals. But is there enough tech talent here? That question is why Amazon may be looking at splitting HQ2 in 2, and why officials in the other finalist cities like Nashville aren't giving up yet.
You can't actually compare bids. I mean, I think I think it's a little bit of what Amazon's looking for. Is it, do they want that larger metropolitan area? Do they want a city like Nashville that I think is going to be more livable?
Amazon could still change its mind. One company official not involved in the selection process tweeting over the weekend that whoever's leaking news about Crystal City is not doing the community any favors. A lesson to all the finalists: don't count your chickens until Amazon delivers them. For Nightly Business Report, Scott Cohn, Arlington, Virginia.
Here's a look at the final numbers today. The Dow Jones Industrial Average rose 190. The NASDAQ fell 28. S&P 500 was up 15. And that will do it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. Get out the vote tomorrow.
Yep.
We'll see you tomorrow.